Welcome to the What's Your Deal podcast, where we discuss business acquisitions, investments, management, and exit strategies. I'm your host, Matt Euler. Let's dive in. Welcome back to another episode of What's Your Deal. I am joined again with Lindsay Denton, and this is part two. This is her third time as a guest, but this is part two of how to prepare your business for sale. So Lindsay and I work together and have for the past 7 years at WCI Business Broker. Lindsay, her title really doesn't do justice, but her title is, there's a lot of titles, but the title that we use most often is loan coordinator. And what that means is that she helps people when it comes time for the financing process of their business. She helps guide them through what's necessary for a complete and approvable application, and also all the way through the process. Now, Lindsay's been very successful at this, and I'll just admit this now, that oftentimes at the completion of one of our transactions, gifts show up, like gifts of all sorts from the people she's worked with, because they are so grateful for how she's been able to guide them through the process and pay attention to the details that are so important to the outcome that they're looking for. So, Lindsay, welcome back.
Thank you.
Yes, absolutely. Yeah. So we started section 1 talking about how people can prepare their business for sale. Mm-hmm. And if there are potential buyers of businesses that are in our audience, again, this is valuable information because honestly, it goes both ways. And most people, and we've seen this as we've worked together, most people who buy businesses end up selling them at some point. So
that's the hope.
Yeah, this information is timeless. And the other thing that we talked about in episode 1 is that we're going to go into the weeds. Mm-hmm. And when I said you're backed by popular demand, I've had lots of people who have commented that literally they listened to the very first episode we did many, many months ago because there was so much content there. It was very content rich, and they'd listened to it several times to extract what they could. So I know in preparing for this episode, we had a lot of fun talking about all of the stories, some tears talking about all of the stories, but there's a lot of value here. And so I'm excited for episode 2. So where do you want to start when it comes to how a seller should prepare their business for sale in this episode?
Well, in episode 1 of the seller portion of this, we did talk about the things that are in their control and more of a tangible piece of that. So the organization of their financials and how they operate their business. The second portion of that would be organization of, let's call it the intangibles, if you will, how they have their entity set up, operating agreement, their assets, those sorts of things that they actually, it's not something they look at every day. Do they check their articles of organization? Do they check their operating agreement? Do they check the title to their vehicles? Those are typically not things that they do on a Monday through Friday basis.
It's funny, as you described what we were going to be talking about, I thought that is so sexy. You know, the articles of organization and the operating agreements and the titles to vehicles. I mean, that's the kind of stuff that a lot of business people just thrive on, which is probably why we end up dealing with it as a surprise.
It gets real ugly sometimes.
Right.
It flips that switch.
Yes. So with such a sexy topic, where should we begin?
Let's talk about
commingled entities.
Commingled entities.
Yes, let's do that. We'll try to keep it clean for any young listeners.
That's right.
Yeah.
So commingled entities, for those of our listeners who don't know what that means, that would be if they're running more than one business or operation under the same entity. That could be the same bank account. That can be the same LLC or corporation, which is fine to a certain degree, but it also can convolute and cause some complications when it's time to sell and extract those two pieces or 3 or 4, how many ever they have within that umbrella entity.
So let's dig into that for a second, because for a lot of people, they form an LLC and they either buy a business or they started a business and they're running this business that way. And then all of a sudden they have a second one. And the commingled part is where you're suggesting they have a second one or a third one. Have we seen a fourth all in one?
I'm sure we could probably dig.
Yeah, back in history. but they run them all under one entity, one EIN number, one tax return. That's where the challenge is.
That is.
Yeah. So
And
walk us through
oftentimes, oftentimes they will have one tax return, and our hope is that they'll have two P&Ls. That's not always the case. And where that really comes into play, bringing this full circle from a seller's perspective, is if you have, for example, a restaurant and a food truck, let's just say, and at some point you decide that you want to sell the food truck portion of that, and you've ran all of your expenses and you've ran all of your revenue under that same entity. So dissecting those two pieces out can be super challenging, if not impossible, especially when you're talking 2, 3, 4 years back, or even 5 years back. So if our hope is that you would run two P&Ls, maybe two classes of business in your QuickBooks or whatever software you use to track your income and expenses, and maybe just one overall tax return. That's one part that can help us or help you when you're trying to sell your business. Ultimately, if you run two separate entities together, so that if for whatever reason one has a problem or one's doing great or one's going to be sold or gifted to a family member, that's a very clean line between the two.
Yeah, so let's drill into this. So for a lot of people, a lot of business owners, and we've dealt with lots of them, especially lately, they can't go back, right? It's just, there's the reason they can't go back is it literally becomes potentially getting loans in another entity and retitling assets and huge complications. So I think the lesson number one is if somebody's interested in either buying a business, buy it in one entity. If you're going to buy a second one, unless it's in the same exact industry, start another LLC and do it that way. I know there's tax return elements and things that it's not necessarily less expensive to have two entities. But like we talked about in part one, these are assets. And when somebody buys a business, builds a business, and they get it to the point that it's a saleable asset, it becomes something of value. And part of that value is determined based on the financial ability of the business to produce a profit. And if we, a buyer, a lender, can't figure out which business generated what portion of the profit or the revenue, or it can be a showstopper. Have we had a showstopper?
I don't think, we've had a listing, or prospective listing that is unable to list until they can actually go through and dissect those two pieces. Actually, I think it's 3 businesses that are all ran in one, to dissect those two so that we can actually say we are going to sell business A, and business B and C you're going to keep moving forward with. So this is, time is money, as we all know. So the fact that we've had to go to that seller and say, hey, until you get these separated, or make the decision to sell everything at one time.
Great point.
Those are your only 2 options at this point.
Because we can't value it.
We cannot value it.
A buyer can't determine what it's doing.
And ultimately, it would never be financeable without being able to break down exactly what that business is doing and at their cash flow. Okay.
So let's talk about 2 more examples. So the other example would be where somebody, and I know you love these, where they are commingled, but you're able to, with several months of effort, work to extract them. A, to verify for the buyer. And again, we can only do so much as a brokerage firm, right? It's just a matter of what the seller can provide.
Sure.
But then it also becomes passing that test for the lender, because the lender needs to feel comfortable that literally the financials they're looking at are for this operation and not blurred or blended with any other activity. Otherwise, they will not proceed.
Sure.
Yeah.
And for sellers who are familiar with, using QuickBooks, let's say for an example, in order to dissect those 2 or 3 ventures, if you will, we're talking line by line expense, and every single expense that you've ever put into your books for the last, let's say, 3 years. And there's been circumstances where we have actually had to have a seller go back and amend their tax return as well, because a portion belonged to a different entity. Well, now that changes. I often refer to this as a Rubik's Cube. We get one thing moved and we've got to move something else in order for it to be streamlined, correct all the way through and through. And I've alluded to it way back. We do it right the first time. We're not going to have to do this again.
Right. And like we talked about in part one, momentum is your friend.
That's
and
right.
Having everything organized up front and less opportunities for hiccups and roadblocks. I mean, this is not a simple process anyway. But if you come into it with the complexities like we're describing, it can be, and I'm just going to give that example, the deal that we just closed. Again, very, very good business owner and seller, but he had some stuff commingled, and we were trying to close that transaction for seasonal reasons, for the buyer's benefit and for the seller's benefit. And the seller had a lease that was coming that he did not want to renew on the premises, but he needed there was all kinds of deadline pressure. And my memory, correct me if I'm wrong, is that we spent a lot of time just trying to get everybody comfortable with the separation between the business activity within one entity.
Well, and to further go into that, the other challenge in it was this was all during tax time. So trying to have the conversations with his CPA to determine exactly how these ventures were classed and how they were filtered to the tax return during tax time, it was, that slowed us down. And again, momentum's your friend. So when you're waiting 2 or 3 weeks to hear back from the CPA to get a clear understanding of how the financials worked and what we can do to, once the tax return's filed, you're backed against the wall or you're going back to square one for an amendment.
Yeah. So to be specific, when we're trying to obtain financing for a business that has, let's call it 2 sets of activities or 2 businesses with one tax return, from a lender's perspective, the lender needs the tax return and then they need 2 P&Ls that coincide with what the tax return states. I mean, that can be challenging. I also think in the example that you gave that there was some accounting errors. By the time that got all separated, that wasn't helpful.
No, that was not helpful. So, trying to say, okay, 1 + 1 = 2, you got this P&L and this P&L and they all filter into one tax return. That's one piece. But then when you've got one is not a full one and the other one is 1.5 and trying to make these match. And of course, we're not CPAs, we're not accountants, we're not bookkeepers, but certainly getting everyone to understand exactly what it is and to ensure accuracy so that when, I don't like to submit something to a lender and then the lender asks me a question that I can't answer.
I know you don't like that. Yeah, so it can be a real nail biter. And that transaction, if I remember correctly, it closed the day the drop dead date, really. I mean, we just barely made it. And we extended that, I think 3 times or 4, just again, because of this issue you're talking about. The buyer was ready, but weeding our way through those financials to be able to get the lender to approve it and the buyer be satisfied. And then when we made those last minute adjustments based on what the accountant gave us, well, then there was less cash flow than we started with. And that changed the whole deal as far as the lender was concerned. So these things compound on each other and can be a huge distraction. And so the last opportunity here is like a couple of our transactions we have right now. We're literally one of them is where we coached people in advance. They have 2 separate entities for the 2 businesses. And even though they are related in some ways, the buyers who are looking at the bigger business of the 2 are every single one of them is asking about the other business. And we are able to say that's a total separate entity, total separate accounting, no commingling whatsoever. And that's usually the end of that conversation. The buyers are ready to proceed with the one that is crystal clear.
That's right.
I think driving the point home, as we often do when we're working with buyers or sellers of businesses, it's like put the other shoes on. And if you're in the business right now and you're working on selling your business or contemplating it, think about it how a buyer would look at what you're presenting. And if there's all kinds of ambiguity around what they're actually getting and what it actually produces in revenue, it does not help.
Well, and to further take that another step, when you're selling a business, history is what it's based on.
Great point.
And so, I'm a real estate agent as well. So when I go to sell a house and the toilet's leaking, we can fix the toilet. And then we get that fixed and we list the home and or the buyer comes in and says, hey, the toilet's leaking, and the toilet gets fixed and we move on. Some of these items that we're referring to with businesses, you're talking 2, 3 year, 4 years back that have to be amended, fixed, corrected, and some of those can never be fixed. So then at that point is when, because of these weren't addressed or there wasn't preparation looking forward, saying I want to sell my business in 2 years or 3 years, I'm going to start doing these items now. They wait until I want to sell my business now, and then we have to tell them you're going to have to wait 2 years or 3 years or whatever it may be if it's not something that can be corrected.
Yeah, and for some business owners, that's an inconvenience. For some, if they need to sell for family reasons, to relocate out of state, health, I mean, they don't have that time.
Yep.
And it can literally be the diminishing of a significant asset just because of how it was set up. Not complicated, no ill intent, just the reality of it.
And it may have done excellent for years and years and years, but when it comes to valuing that business and being able to make it saleable, it may, that's a make or break.
Yeah, if we can't prove it, it didn't happen.
That's right.
All right. So let's move on to landlords, one of our favorite topics.
Or the least.
You're right. So there's an interesting dynamic, and I'd love you to give some examples, but for our audience, there's an interesting dynamic when you own a business and you're leasing the premises. I've seen landlords who literally, when the lease expires, evict the tenant, don't renew the lease. It's no problem. They just don't renew the lease and then open the exact same business that was there because it was successful, right? I've also seen landlords where they're not willing to do an assignment of a lease. I mean, there's all kinds of factors that come into play that we deal with all the time. Tell us about some of those stories that you might recall and some of the caveats with. There's so many. Wherever you'd like to start, go ahead. I'll follow you.
Well, I would say probably the most unfortunate aspect of landlords is oftentimes they can become greedy. So they've had a tenant in there paying them the same amount or maybe a small amount of increase every year, and then they get wind of a buyer coming in, and now all of a sudden they decide that their building that they've been leasing for, let's just come up with a round number, $2,000 a month. Now they want $3,000 or $4,000. Well, when we put the package together, we don't, it's what comes first, the chicken or the egg here. And so oftentimes as the transaction evolves, we have a landlord that isn't aware of a new buyer. And then when they become aware, that's when the greed tends to set in, and those numbers no longer fit in what the business can pay for itself and afford for a lease that's now double or triple.
Yeah, and we've certainly had deals that died just because of that. We've also had situations that I can remember where landlords believe, and maybe rightfully so, but listen, it's my location that's bringing value to this business, not necessarily what you're doing with the business.
Sure.
So therefore, I deserve a fee upon the assignment of the lease, or I'm not going to assign it. They really, I don't want to say they're a disinterested party technically, but to a certain extent, they've already got a tenant in most cases, and they already have a lease. So what is the incentive for them to sign up with somebody new that they don't know so that the seller can make a bunch of money? It creates some challenges for sure.
Well, and landlords, they operate a business, but their business is such a different model. Their business is the ownership of that premise or multiple premises. And so they have a commodity, and a lot of times, especially in retail, they think that they hold the cards there, and in a lot of aspects, they do. And so, with that being said, they kind of are able to call the shots, and whatever that may be, they don't want another tenant, they want to increase it, or completely kill it, because they have other plans for that spot.
Well, there's so many examples. I actually, as you're speaking, I'm remembering an example of a business that I evaluated for a gentleman that the value was about, let's call it $1.1 million. Okay. All day long, I sold him the business, right? So it was just better than when he bought it. I had worked with his landlord many times in the past. So working through the listing process, he had not, his lease was coming up to expire. And he asked if I would talk with the landlord because I've got a great relationship with that landlord. I've done a lot of work with them over the years. So I contacted the landlord. And if I remember correctly, she just smiled at me and said, no, I'm not renewing the lease. And I said, okay, so there's probably more to the story. What's going on? She goes, I have sent him notice after notice about him not opening during the hours he's supposed to, not closing when he's supposed to, having customer complaints for the way he treats people within our, and again, it's not really within within their development. So he's affecting the revenue from my other businesses and my other tenants because of the way he's operating. So I've warned him verbally and in writing, and he's ignored all of them. So he's not getting his lease renewed. So literally, this gentleman lost $1 million asset simply because the landlord wasn't willing to renew his lease. And honestly, I can't blame her. And she already had, there was the other thing. She already had another tenant ready for it. So it really is that simple. So landlords can be very significant and important. So what do you think a seller of a business can do to prepare for a sale when they've already got a landlord? Let's talk through some of those dynamics.
Sure. First and foremost, making sure that they have a lease or some sort of an agreement. There's times where we have sellers that have been in a spot for a very long time. They're going month to month and they may have a line of communication, but it may not be a strong line of communication with their landlord. And, they have no lease. They're just biding their time there, and having a conversation with the landlord or making sure that they have proper documentation and getting that feeling on whether or not, a prospective buyer would be able to move forward with a lease would be fantastic.
Well, I'm working with a client right now who's in the exact same situation. So he has, let's call it roughly a $4 million asset, been in the same location for a long, long time. So literally no lease. And the landlord's been super flexible, great guy, friendly, but he's elderly. And so the seller's been, the owner of the business, the seller's been a little reluctant to sign a new lease because he might want to move or buy his own building or do something different. But we have a buyer. And so as I'm talking with him about the significant value of his retail mostly, there's a service component, but retail mostly related business, that if he does not end up with that lease, the value of his business dramatically gets impacted. Now, could he find a new location? Sure. Could he find potentially a better location? Absolutely. But until he's able to prove that it's a better location financially with his records, most astute buyers are going to consider that's a warning sign. And how do they know it's better until it's proven?
Sure.
And so he's in the process right now of securing that longer term lease, not 15 years, but a short-term lease with options to renew, which is what a buyer is going to want in order to protect the asset he has. There's one other point, since I'm on a roll here with this story. One of the things that I mentioned to him is people die. And if the landlord that he's been working with and had no problem for his entire tenure at the premises passes away or decides to sell that building and he ends up with a new landlord, all bets are off.
Yep.
So it is super important to lock in and protect the asset that you're building if you're a tenant with a business, to make sure that there's some longevity there and you can't get kicked out, removed, not renewed, those kinds of things.
And certainly in the retail scene.
Yeah, we would call that location specific, right? It's a much bigger deal. So what are some of the other things you've seen around rented premises that are important for somebody who's considering selling their business to be prepared for?
One of the other items would be having a written lease. We've talked about that just momentarily. And it can take a landlord, especially if the landlord is elderly or there's, a property manager in place, it can take them a significant amount of time to get a new lease written for a buyer. So having that at least queued up or having a lease ready to go, knowing that a new lease can be written for the buyer, maybe some changes or an assignment on that is certainly important. I mean, we've had to participate in many of the transactions, assisting the landlord as well with getting a written lease put into place.
just another example of how we go above and beyond. But yeah, the story you're referring to, we were ready to close almost. And the landlord's saying, well, I don't even have a Word version of the lease. And I can put one together. I mean, he was no opposition, but literally timing was, 4 or 5 weeks. Is that good? And we're like, yeah, we're supposed to close in 2.
Like 4 or 5 days is when we need it.
Oh my gosh. And there's a reason why we didn't ask for it well before that. But yeah, we helped him write his lease and then he approved it so that we could have it in the time frame we wanted and was best for the buyer and the seller as opposed to when he got around to it. So you've had some fun with some environmental concerns regarding. Can you give us a story about those examples?
Sure. So location obviously is very important, and sometimes those locations, depending upon the industry, can be less than desirable. Oftentimes, a lender is going to need to do a phase 1, so they're going to come in and take a look at the building and the premise to make sure that it is something that they actually want to have their borrower in. And so there's been a number of things, oil leaks all over the ground, or actually oil that has seeped into another premise that shouldn't have. A number of things that become less than desirable. One, for a buyer's perspective, but certainly 2 for a phase 1.
Yeah, so that's and I'm smiling just because I remember the pain of these examples. But there was one where we were getting ready to close, I believe, and literally, like you said, the landlord had concerns because the tenant next door to the one we were selling had oil, like motor oil, leaking under the wall into the other tenant's premises. So they were a little uncomfortable assigning the lease until that was addressed. So that would kind of guide us to another aspect of how a business owner can prepare their business for sale, which is being ready for guests. Yeah. And guests being typically when you list a business for sale, the prospective buyers are going to come in as customers, confidentially, but they're going to come in as customers, but also for site visits. So what kind of gems can you share for somebody around having their business premises ready for guests and viewing?
Well, the electricity on and working, the lights working, running water. And then it's like when you invite someone to your home and your children are misbehaving, making sure the employees are relatively on their best behavior and how the business should be operating.
Yeah, so no oil leaking under the walls.
No oil leaking.
Yeah. The reason I chuckle about...
No costumes.
Yeah. The reason I chuckle about the electricity turned on is I forgot the story about where I was working with a buyer and a seller at a business, and it was after hours, so the staff would not be there. And literally there were no lights. So this was an unsuccessful transaction, I might add, because as we're walking through the premises with our phone flashlights on, trying to demonstrate for the prospective buyer what an amazing business this was, you can imagine how they didn't agree.
And if I remember correctly, it was a manufacturing business.
It was a manufacturing business. So
lights are kind of important.
Oh my gosh. So some of this stuff goes without saying, but honestly, the owner of that business has been running it that way for a long, long time. He never has people there after hours. Not a big deal. That would be maybe a good example of being prepared for guests.
That's right.
Yes.
And not becoming complacent to what your premise looks like.
Yes. For sure.
First impression.
Yeah. The first impressions are important. And we deal with that all the time. These are businesses, right? They're not homes. People, they're in production of whatever service they provide or component of activity. But they still, ideally, you want to have your best foot forward and have them look great.
That's right.
Any other suggestions about when it comes to being ready for guests that you might want to point out or stories you want to share that are fun?
I think the lights, those are the ones that come to mind.
Yeah.
Oil leaks.
Yeah, just overall maintenance. There's another one that I'm working on right now where the location of the business isn't tremendously site specific, but literally some of the ceiling tiles are not ceiling tiles, but roofing tiles are missing and falling off, and paint. I mean, those are all, it's in the big scheme of things for a significant asset. Those are minimal expenses and they speak volumes to the care of the business and the operation of the business. And those subconscious, subtle things can go a long way for sure. So let's wrap up by talking about titling of assets. And again, another super sexy topic. But let's chat about that for just a minute, and then we'll close out this session.
Okay. There are times when a seller has their, let's say it's the vehicles, or it could even be the real estate titled in other entities or their personal name, or, it could be in someone else's name. It never was transferred over. And those are fun surprises. I think I mentioned this in our last podcast. When you look both ways to try to make sure everything is good, looking both ways before you cross the road and getting hit by a plane, not knowing that a certain vehicle or the property is titled incorrectly or is going to become a huge challenge to get to a point where it is saleable.
So how could that even happen? And I asked the question rhetorically because I know how it can happen. But how could that even happen? How could somebody have an asset in their business that's not titled correctly?
Well, let's use real estate for an example. You've got, let's say, a husband and wife that owned the property, and we're going to sell the property. Well, let's say wife passed away, or got divorced, or we are not sure where she's at or he's at. So he's not going to be there. She's not going to be there to sign off on their portion of the ownership. We've had that happen.
Yes.
And we could have estate issues, probate issues, that certainly if that's taken care of ahead of time, it's going to be a whole lot easier making sure you've got your operating agreement or your articles up to date before we head to even anywhere near closing.
Yeah, and I know we see it frequently with vehicles. I mean, if the business that we're working with is rolling stock intensive, well, we find some interesting things on that area as well.
That's right.
Yeah. So what happens is people end up buying, they got a good deal on a truck, they went and paid cash for it, and it got titled into their name. And when it comes time to sell it, I've been at many closings where if we didn't catch it up front, literally the seller is leaving the closing table to run to a Department of Motor Vehicles office to retitle some assets to make sure that they're in the right name, or lien releases, right? It's like, I paid that car off 4 years ago. Well, if you can't prove it, it didn't happen. And so how do we get to the other side of that? I mean, those are the kinds of things that certainly contribute to a seller being prepared to sell their business up front, is just a simple check of, okay, I've got all of the titles to my vehicles. They're all in the name of the business. These little things go a long, long way towards a smooth transaction. And back to momentum is our friend. The transaction where you referred to, where the real estate was not handled correctly through probate, and the husband had actually passed away, that delayed the closing. Refresh my memory.
About 3 weeks from the time that we discovered it, through everyday phone calls with their attorney, with the seller, with the escrow officer, actually the escrow officers who she reports to, her manager, myself, trying to determine what the best route was to mitigate the problem or correct the problem after the fact. And, one of the other pieces of that is it can be costly for the seller, especially when they weren't expecting it. So, one example that I can remember is we had a roll-up, and the gentleman never retitled any of the vehicles into his new entity that he was operating under at that point. And so in order to be able to sell the business, not having those vehicles in the name of the business and having to retitle them and then retitle them again, if I remember correctly, it was something along the lines of $5,000 or $10,000 to re-register all of those vehicles, those service vehicles, in order for them to be in the appropriate name to transfer to the new owner.
Yeah, so to pull that apart a little bit, a roll-up is where an existing business in a specific industry buys another business in the same industry, and they roll them together. And so the seller in that situation, when he bought those vehicles, didn't register them in the name of the correct
entity.
company. So therefore, it comes time to close, and he had to spend all this money to re-register them and retitle them, and time, just simply to have that of no value and the buyer to buy them. Yeah. The challenge, and I totally appreciate this, the challenge is, a lot of people don't, we know, none of us know what we don't know. But some proper education and preparation goes a long, long way towards having these issues not be devastating when it comes time to the business.
And most sellers are focused on running their business. They're not focused on, is the title to the Chevy truck in the correct name, or is the real estate in the correct name, or do we have an operating agreement that's up to date that talks about who has the authority to sell the business or to sell the real estate.
Yeah, it's definitely the day-to-day is easy to get focused on when you're running a business. Mm-hmm. This is a whole nother project that most people have never been through. Mm-hmm. So, well, another great episode full of valuable content. And I know we're doing a whole nother series, which will more than likely be a 2-part on how buyers can prepare themselves to be ready to purchase a business, which is equally as important when it comes to buyers. And as you know, I finish all of my podcast episodes with asking the guest to share an example of somebody who gave them a hand up or saw something in them that helped them get to the other side. And I know how much you appreciate opportunities for gratitude. So can you give us another example of somebody in your life that just gave you a hand up when you needed it?
Well, this being the third podcast.
I know, you're getting so good at it.
I feel like I used too many in the first couple. But I do have to say, it's not just one person. Yeah. It is the tribe you have around you. Friends, family, spouses, siblings, parents, whatever that may be. There's many a times in this career and in previous careers that my husband was there stapling packets for me or, bringing me dinner at midnight while I was working because that's what the duty called. I have friends who see things in me that I don't necessarily see, good, bad, and indifferent, and remind me of those shortfalls or the good things that they see in me. And, sometimes it's just the one little thing that helps you remember, I can do that, or I am good at that, and drive you a little bit further in your career or in life. Yeah. And I have an excellent tribe around me.
That's great. And I appreciate you digging deep to continue this conversation like this. But knowing Troy, your husband, I agree. Yeah, I can't even think of anything that you would ask of him that he would not do.
He would do it.
Yeah, he's always got a smile on his face when I see him. So he must be doing something right. So, well, thanks again for all of this valuable detail.
Absolutely.
And I know it will serve our audience well as they prepare their businesses for sale. And I look forward to our future episodes.
Yes. Yeah. Excellent. Thank you.
Well, thanks for joining us for another episode. I hope you've extracted phenomenal information that will serve you on your path here, whether it's selling your business or preparing it for sale or to buy one. And we look forward to seeing you on the next episode. And that's a wrap on today's episode. We hope you enjoyed the conversation and got some valuable insights into the world of buying and selling businesses. Want to be a guest on our show? If you have a deal that you'd like to discuss with us or a business story to share, we'd love to hear from you. Shoot us an email using the contact information below in the episode notes, and let's make this happen. Never miss an episode. Make sure you subscribe on Apple Podcasts, Spotify, or wherever you listen. And if you found today's episode helpful, please leave us a review. It helps more people like you find the show.